Back to the conference, and welcome to this Investment Readiness Fund session, the Investor View. I'm Helen Avery with the Green Finance Institute, and I'm going to be joined today by 4 panelists, and we'll be discussing what makes investment readiness from their standpoint. But before we begin, I'm going to invite Dan Barwick to take the stage from DEFRA to say a few words about the IRF. All yours, Dan.
Thank you, Helen. Hi, everyone. I'm Dan Barwick, as Helen said. I work in DEFRA's Green Finance team, and I'm pleased to have the opportunity to give you a brief intro to the Natural Environment Investment Readiness Fund, which we're currently in the process of designing to open for applications in the new year. And I'll make this quick, not least because some of you may have heard me say this at yesterday's session. So first, a big thank you to the GFI for leading these sessions and for the expert panelists, and indeed to the EKN for hosting as part of the conference. And to complement these GFI sessions, we're also staging some stakeholder sessions led by the Environment Agency, who will deliver the IRF on behalf of DEFRA Group, to go into more detail on how we're proposing the IRF will operate, so we can get views to inform our thinking on that. And we'll provide details on those sessions later. So a very quick intro to the Investment Readiness Fund. At its core, the IRF will be a competitive grant programme to enable natural environment project developers to boost their capacity and procure the specialist advice and expertise they need to develop their project to the stage that it's ready to receive and operate on repayable investment. So it will be a technical assistance programme rather than a fund that makes capital investments in projects on the ground. So we're interested in receiving bids from projects that can broadly do 2 things. Number 1, protect and enhance the natural environment in line with the 25-year environment plan. And secondly, generate revenue from ecosystem services in order to attract and repay investment. The aim being to increase the funding options available for natural environment projects. So the exact investment readiness needs will vary from project to project, but could include support and advice on things such as financial modelling, revenue generation, investment structuring, capital raising, governance advice, impact measurement, etc., etc. The list goes on. We've drawn inspiration from the social investment sector, which has grown rapidly over the last 10 or 15 years, supported by public investment readiness funding. And while we see this kind of capacity and capability building support as a crucial step in helping to build a pipeline of investable natural environment projects, we realise it's only one part of the support needed, and that we need to align other sources of public funding to enable blended investment, and we need the right enabling policy and regulation. So I'll leave it there for now. I'm very much looking forward to the discussion. And as I said, we'll provide info on the Environment Agency stakeholder engagement sessions later on. Thank you.
Thank you, Dan. We're all really excited about the fund. And welcome to our panelists. We have joining us today, here they all are, Richard Speaks, Founding Director of Finance Earth, Sarah Barber, Senior Sustainability Manager with Lloyds Banking Group. We have Martin Berg, Partner with Pollination Group, and Dan Hurd, Head of Corporate Finance at Triodos Bank. So a very warm welcome to you, and thank you so much for joining us, and welcome to our audience. We're going to be talking for about 45-50 minutes or so, and then opening up to Q&A. But you are very welcome, and we encourage you to post your questions in the Q&A option at any time, and they'll be collected behind the scenes, delivered to us, and then we'll put them to our panel at the end. So before we open up sort of a general conversation about the specific challenges and opportunities that intermediaries, banks, investors are encountering with regards to financing nature, we wanted to take a bit more time to introduce our panelists so that you, the audience, can more fully understand how each is working in this field of nature and finance. So Rich, you're in the hot seat first. Congratulations, by the way, on the Blue Impact Fund. I've been hearing about that today. Could you share with us, just to get us started, a little more about the approach Finance Earth is taking when it comes to developing investable vehicles for nature?
Yeah, absolutely. Thank you, Helen. It's nice to have an opportunity to get dressed up for a change. And thank you to yourself and Marie and the entire GFI team. I'd just like to echo Dan's thanks for putting on these sessions as part of the conference. I think we all really value them, and thanks for all the work. So anybody that followed the marine session has probably heard some of this, but for the last 2 years, we've had quite an interesting journey, and certainly started out with more hair. And it's been fantastic to have such committed partners as Sky Ocean Rescue and WWF to work with. And we're really pleased to be launching our third fund for environmental impact in the 4 years that Finance Earth has been around. But let me start on our approach by sort of rowing back a bit, and just sort of saying that, I think it's really important that we don't see investment as a silver bullet. Repayable finance is not cure-all, and it's important to acknowledge that investment is not the right form of funding for every situation. I think yesterday there was a couple of comments made about how do you value a barn owl, and absolutely right to be thinking about where you can use repayable finance in the right places, and where it can be used, and it can free up some of that more scarce, precious grant, philanthropic, public funding to do some of the more deeply impactful stuff that will never be financeable. We think that's a good thing. So I choose the term repayable finance on purpose. It's kind of the first key for me in understanding, how we approach where to use it. So we look for projects or potentially investable models that have a clear line of sight to cash flow, whether that cash flow is a revenue, whether it's a cost saving, either yours or somebody else's that can be monetized, or whether it's a capital uplift, a land value increase that can be realized. Cash flow is needed to ultimately repay that investment and any kind of return that's needed on top of that. And that ability to generate the cash flow and the certainty around those revenue streams is fundamental in first of all working out whether repayable finance or investment is even a tool in your toolbox for your project. Our investment advisory business for us has been pretty fundamental actually in being able to go out and test that in a variety of areas and find some of those solutions that we can scale. And that was the development process for the Blue Impact Fund. A great example of kind of that approach. We spent a lot of time working with WWF for 2 years, testing a variety of models that could have been very impactful for kind of the marine environment, but ultimately didn't really provide us with those investable characteristics with sufficient confidence that they were going to be ready for investment at the scale of ambition that the Blue Impact Fund was targeting. So for us, if a project can demonstrate those cash flows and we've got confidence in the underlying business model, then the next most important thing to work through is the right form of investment and trying to match off, is it a debt product, is it an equity product? And then once you've worked that through, ultimately, are we the right partner for you? Are we providing the right kind of capital for you? So in short, the right capital for the right activity and then the right partner. And that really is fundamental to kind of our approach. We prioritize partnerships, and any good investor will probably tell you they're not only investing in the business or the project, they're investing in the team that's developing it and running it. And as a social enterprise ourselves, it's pretty critical to us that those people are mission aligned. So whether it's an environmental NGO or a mission-driven entrepreneur, really important that we're all seeking to create an environment that balances, the financial return that's required for investment, but also the impact, both social and environmental. And I think many of the opportunities that we see at the moment are still striving to work through that balancing act, but we're really excited about kind of the pace of the market and how fast it's moving at the moment.
Great, thanks, Rich. I'm very excited to sort of hear your thoughts later about what actually does work in terms of the projects and what you're looking for when you're putting together a fund. Just briefly though, given you've worked in social finance and you have renewable energy investments at the heart of one of your funds, the core fund, could you share with us the differences between investing in nature and the financing of, say, renewables and even the social finance movement? Because they're very different. I'm not sure everyone quite sort of understands and stands out. So it'd be lovely to hear your thoughts.
Yeah, of course. Slightly random walk to get here, as you've said, through sort of private mergers and acquisitions into social investment and then into the sort of environmental impact market. But we founded Finance Earth in 2016 on the premise that we could use those learnings from the development of the social investment market and also the tools and techniques that exist in private finance, to be honest, to really accelerate investment in nature. And oddly, sort of looking over the pond at what was happening in the US in quite a jealous fashion, which is it's not often we can do that. But you're absolutely right. The first fund that we did, Core, sits at the intersection of social investment and green finance, and set out to prove that community-scale renewable energy projects could be aggregated and could access institutional finance, as well as recycling those surpluses back into that community dividend and capturing the benefits for local economies. To be honest, it was comparatively easy to investing in nature. Those projects are at sufficient scale to attract private finance. The £3 to £5 million a pop. That's led to us having a £50 million portfolio today that we can offer to investors. And those projects have been generating really demonstrable revenues from either government subsidy or selling the energy to large energy supply companies. And I think that's why green finance has exploded. But those bankable revenues are much fewer and far between for nature-based projects. And so we've got some catching up to do. But I think that's coming. So, we're obviously seeing the advent of ELMS, biodiversity net gain, carbon, all of these ideas that have been talked about over the last 2 days in the conference, and seeing ever increasing activity of people wanting to come and invest against those revenue streams. But for us, much of the last few years have been about proving kind of the ecosystem service deliveries, and then trying to monetize that, and then trying to find people to pay for those ecosystem services as a beneficiary. And there's been a number of successful projects, but they've been done on quite bespoke circumstances. And because of that, they've been really tricky to scale and replicate. And I think that harks back to what you were saying about the social investment market. When I joined that sort of 6 years ago, it was a broad church of impactful organizations trying to deliver what was termed a fair return, or even some sub-market returns where impact was sort of outstripping some of the return for the investors, but across a range of sort of new or innovative business models. So that feels like we're in the foothills at the moment of the environmental impact market. But the social investment market, went from a couple of $100 million to sort of 5 billion in a little over 10 years. And that was really accelerated over that period from government intervention. And so, we saw Big Society Capital, the 600 million wholesale bank for social investment, come in. We saw 100 million or more of investment readiness funds from government, from lottery, from charitable foundations. And so all of these demand and supply side interventions allowed many new investors, both private individuals all the way through to the big institutions, to kind of enter the impact investing market, but sharing or reducing some of that risk of testing and developing the market. So as fantastic as the £10 million IRF program is that Environment Agency are delivering, we and our partners are still calling for further government action, and I'll cover that later in the conference actually. But learning from that kind of internationally recognised process that we did with social investment, and put the UK as a global leader in investing in nature like it is in social investment.
Thanks, Richard. And I think we'll open up as a conversation a bit later and talk about how we build pipeline and the importance of scale, and maybe having government support to de-risk some of these projects. But turning to you now, Sarah, thank you so much for joining us. Can you share with us a bit how Lloyds is approaching UK nature from a finance perspective?
Yeah, of course. Hi, Helen. Hi, everyone. Thank you very much for having me. And again, congratulations on a brilliant conference so far. So we look at nature in a number of ways. We have a few kind of critical proof points, but I guess the overarching story for us is that we want to finance the transition to a low carbon future, and we've made a big commitment to halve our financed emissions by 50% by 2030, working with our clients, customers, government and others. What that means is that the emissions we finance, for example, via the agriculture sector, where we're the largest lenders, we have a responsibility now to set a sector-specific target and bring those emissions down. And so that will obviously affect both our lending and our investments in that sector as well. So some of the key ways that we're making a difference on nature already. We have a big, large-scale partnership with the Woodland Trust, where we've committed to plant 1 million trees a year and 10 million over 10 years up to 2030, really to commit to the UK's reforestation challenge and efforts. The CCC has been clear that the UK has one of the lowest levels of woodland cover in Europe, and therefore there's quite a substantial change that's needed there. About 90% of the trees that we're going to be planting are going to be on agriculture land, so essentially providing discounted trees and hedges to farmers and landowners. And so that is also leads on to the next proof point, which is we've just launched a sustainable agriculture proposition. And again, that sets out our ambition to support the agri sector specifically transition to net zero by 2040. And that proposition is made up of a number of proof points, from partnering with leading carbon calculator companies, so 3 of the top market leaders to support clients and others to undertake a kind of carbon assessment at farm level. Running regular sustainability information sessions. We've expanded our green lending offer, which I can talk about as well, and obviously that Wood and Trust partnership. But we recognise, in particular in the agriculture sector, there's a long way to go. We're also going to participate in the TNFD, the Task Force on Nature-Related Financial Disclosures, which I know we've heard about a bit as well this last couple of days. I think our concern there is that it's a way off, and so how do we start to account for risks and opportunities related to nature and biodiversity earlier is probably a primary concern for us at the moment. And then of course our big headline lending project at the moment on this is our Clean Growth Finance initiative, and that provides discounted lending to environmental projects. And we have recently expanded that to take account of the agriculture sector proposition. So we now lend to a far broader range of assets and are really trying to take account of that kind of those nature projects on the ground through that product as well. So those are, I think, the key things that I would highlight.
Great. I mean, sort of maybe keeping in step with your discussion around sort of risk and working with the agri sector. I'd just be sort of interested to hear, do you have a sense of some of the projects that they're using, or some of the nature-based tools that they're using to reduce their carbon emissions, and whether, I'm just sort of interested to hear what they're doing and how that's impacting how you're looking at risk?
Yeah, so these tools vary in kind of size and scope and scale, as you can imagine. But the 3 top that were kind of almost voted by Farmers Weekly, etc., as being the most robust in terms of spitting out what your carbon footprint looks like at kind of a land level. We're partnering with them, and a questionnaire can take as long as kind of 15 minutes, and you can imagine that you wouldn't get a hugely detailed response there, or kind of up to a couple of hours. And the idea is that it gives you your kind of resource intensity. It measures all of your kind of inputs and outputs at a farm level. And the idea is that they then share that data with us in order that we can purportedly help finance changes to those specific issues. So at the moment, what we haven't used this as a tool to understand climate-related risk. We're at relatively early stages with that. So we're obviously implementing the TCFD. We're working on embedding climate-related risks into our credit risk operating model. And the agriculture sector is one of our focus areas across, amongst other sectors. But we're at quite an early stage on kind of how we use that data to inform risk.
I think it also shows, just from hearing, the impact of something like TCFD for how you're then lending, how important the TNFD is going to be then.
Yeah.
In terms of sort of driving capital and, as you say, discounted lending to sort of nature positive projects. And maybe we'll have time to get into that bit. But, oh, sorry, please respond.
No, that's exactly right.
Super, thank you so much, Sarah. Martin, coming to you now. Welcome. It's a pleasure as always to see you. It was such big news this year that HSBC Asset Management were teaming up with Pollination as a joint venture. Can you tell everyone a bit more about this venture?
Sure. Thank you, Helen. Thank you very much for the invitation. Good afternoon, everybody. I'm really pleased to speak here, and congratulations on the conference so far. So I work for a company called Pollination, which is an advisory investment firm based in Australia, the UK, and also in the US. And we teamed up in August with HSBC Global Asset Management to form a new company called HSBC Pollination Climate Asset Management. And what that is really an asset management company that is solely focused on offering large-scale real asset investment opportunities for institutional investment in the area of natural capital and also carbon. But the first product that we are thinking of is on natural capital. And maybe to give you a bit of background to what the rationale was for this joint venture. So on the Pollination side, Well, Pollination is actually a very young company. We just celebrated our first anniversary. But even before Pollination was born, I think the need to bring scale into international capital was something that the entire group always saw, and that we saw a little bit also as a crux as a market at the moment, that it's very difficult to really get into the mainstream and to really scale up without attracting larger scale investors. And so we've been working on many ideas before we actually had the connection with HSBC, but this only really took off with HSBC. Well, fully understanding that this is actually one of the key challenges to this market, and the global asset management team really understood that there's an opportunity to bring a smaller an investment team that exists, but probably in much smaller vehicles to a much larger audience. And that's really what we're trying to do now. So where we stand is we just incorporated the company. We're 2 months old. I'm now officially also moved over and employed by the new company. We're going through our regulatory approval process, and we hope that we are in a position next year to be fully authorized to launch our first investment products. And that's obviously now that we're building out. So we're having the first early discussions with potential investors. We're looking at projects, both. So it's a global strategy. Maybe I should say this. So we really would like to raise a large scale investment vehicle. But we are also, for example, we're looking at a few opportunities in the UK and to see whether they could fit into this strategy.
And correct me if I'm wrong, but I think the initial focus is sustainable forestry and sustainable agriculture.
That's true. So what we're trying to do is really when we're thinking, okay, how can we actually get this investment theme, natural capital, to large scale investors? And so I think we have to demonstrate that this is possible with real asset returns and with investment projects that actually are understood by investors. So the core of our offering will be sustainable forestry, sustainable agriculture. We will look very closely into regenerative agriculture practices, not only in the UK, but also, for example, in Australia, in the US. So we do think that the main geographical areas will probably be Australia, Europe, and the US. But we also have ambition to look into more challenging projects. So for example, we see a few interesting ones in some rewilding projects, some combination of agriculture and forestry, also in the UK or in Europe.
Oh, fantastic. Maybe we'll talk about the difference between, or some of the challenges around the UK when it comes to scale a bit later. But thanks, Martin. It's great to have you here. Dan, moving on to you now. Finally, thanks for sitting patiently. You are representing the Intermediary on this panel. Can you share with us a bit more about some of the work that you've been doing with DEFRA, the Environment Agency, Esme Fairbairn Foundation, on these new investment pilots?
Yeah, thanks, Helen. Good afternoon, everyone. It's great to be here, and good luck with the conference. I work for Triodos Bank. We are, Europe's sort of leading original ethical bank, and we operate in 3 areas really. One is core banking, 2 is in investment funds, and thirdly, the bit that I sort of look after, which is the advisory project development side of the business. And we observe that this is an exciting new sector, but there is a distinct lack of investable projects where we are at the moment. So we decided to focus some of our efforts on getting our sleeves rolled up really, and trying to identify what some of the barriers are to creation of investable projects. And it was at this conference actually 2 years ago that we put out a call for potential projects. We had quite a considerable response from some of the attendees, and we managed to get some support from Esme Fairbairn Foundation, EA and DEFRA to finance the development of 4 pilot projects. And 18 months later, we're still working on those projects. We're learning a lot. And the 4 projects themselves, I think, are going to create some quite valuable learning for sort of future scale up and replication. So on those 4 projects, just to sort of quickly run through them, one is a river catchment, the Wyre River catchment in the Forest of Bowland. This is a natural flood management led project where we're looking to monetize natural flood management, reduce flood risk for the catchment, and also look to monetize other ecosystem services such as carbon, biodiversity and water quality. So the learning in a catchment scale project is quite immense, actually, because there are simply so many stakeholders. So you've got multiple buyers of natural flood management services. We've got multiple landowners who will host the interventions. And we're trying to monetize, 4 or 5 different ecosystem services. So, a great project to learn on with a view to scaling. Second project is in the Carn wetlands down in Devon. This is an ecotourism salt marsh creation-led project. What we're doing down there is talking to the landowners who are facing 2 existential threats to their business, really. One is climate change resulting in rising sea levels and potential flood breaches of defences. And the second one is a transition away from, common agricultural policy subsidies towards ELM in 2024. So, a lot of farmers and landowners are looking for alternatives to current land use and taking into account threats of climate change. And, what we're trying to create there is a new model, change of land use. So it's quite interesting engaging with those landowners and seeing what we can do. The third project is led by Moors for the Future in the Peat District, and is a peat restoration project where the primary driver is sequestration of carbon in peat. And the final one is a Poole Harbour NFU-led project all around phosphate removal from Poole Harbour. So quite a variety of projects, lots of different ecosystem services we're trying to monetize. We're not just learning about generating cash flows, though. We're also learning about governance structures and how landowners and buyers of services, react to the proposition we're putting forward. So tremendous amount of learning. Also, what is the role of the Environment Agency in helping some of these projects get to the point where they're investment ready? So really, Helen, we're focusing on really some quite sort of early stage projects, which hopefully will ultimately come through and be looking to raise investment.
Fantastic to hear, and I know that we'll be hearing specifically about one of those projects in our session tomorrow from Devon, and the amount of information that you must have about what works and what doesn't work, and we'll come on to that in a minute when we open up in a conversation. But just finally, while we have you, Triodos is working, to bring capital to nature-based projects through its crowdfunding platform, and we heard a little bit about this yesterday from Trees for Life. So I wonder if you can just tell us a bit more about that as an option for raising capital.
Yeah, absolutely. We're open-minded as to where investment comes from. It could come from straightforward banking. It's really great to hear Lloyd's getting so involved in this sector. It could come as equity or risk finance from an investment fund that might come from pollination or environmental finance. Equally, we've been quite successful in raising money from retail investors, particularly in the social investment space and renewable energy. And then you might supplement that with grants. So this whole concept of being open-minded as to what is the right source of investment for a project is important. And as you say, we're working with Trees for Life, fantastic Scottish charity, working on an ecotourism rewilding centre in their estate in Scotland. And that one, so we're talking about a £5 million project where the charity will put some of its own funding in. There is some grant funding from DEFRA, and we're going to be working with them to raise a £2.5 million bond, which we're going to be marketing to retail investors on our crowdfunding platform. So it's a great opportunity for ordinary members of the public to invest directly in a charity which is promoting rewilding. Then I'm sure if you become a bondholder, you'll also be a potential customer of the charity. So it's a way really of the underlying charity supporting the creation of a fantastic new resource in Scotland, and then ultimately the rewilding centre will support the charity's rewilding initiatives as they move forward and pay off the finance.
I know that also one close to my heart is Fish Tech Marine, that's been on your platform, that developed sonar pingers to save dolphins and sharks, I believe, down. That was actually one of the most successful transactions we did. Actually, took off. It was quite a small equity raise, tackling the massive problem of global bycatch. So many species are at risk around the world of being caught inadvertently in fishermen's nets. And through some relatively simple technology, dolphins and whales can be deterred from these huge fishing nets that a lot of the major fleets use around the globe. So British technology, we raised about £500,000 through an equity investment, and that really is starting to take off quite
quite considerably now, with more regulation coming in about managing bycatch around the world. So there's some great success stories out there. We just need to do some of the hard yards, I think, on some of these projects and work out what works and what doesn't, and then look to take that learning forward, and always with a view to scale and replication.
Which is a perfect segue, Dan, into opening up the conversation to the whole panel now. If we can bring everyone back, fantastic. So really the question is, what makes a project investable, financeable? What exactly are you looking for? Rich, do you want to start us off?
Yeah, so I'd probably go back to echoing my sort of opening statements, and sort of, the starting point for all of this is if you want to bring investment into a project, there needs to be some way to repay that investment. Whether that investment requires a return or not is a separate question, but most investment at least requires its capital back. So as a starting point, some sort of robust cash flows, or at least a line to those cash flows, and seeing how they might be delivered. And that could be from ecosystem services, or it could be from simply delivering products or services from natural assets and enterprise models, or it could be from delivering services to the public sector. So there's a whole range of options through that. And I think once you kind of understand what those sort of cash flows, those revenue streams, those cost savings look like, you can start to work out whether or not you've got an investable proposition. Beyond that, we start to think about, as I said, is this a backable team? Do they have the capability, capacity to be able to not only deliver the project, but also manage that project in the long term? Is there solid governance around that project? I think Dan alluded to catchment scale projects. A lot of our terrestrial projects and non-marine projects have a lot of different stakeholders, and herding those cats into some sort of governance structure is hard work. But if you don't get that right, it can completely derail your project. So making sure that's kind of there, and of course for us, demonstrable impact. And we're fortunate that we work with a lot of partners like the RSPB, the National Trust, the Royal Society of Wildlife Trusts, and of course WWF. But the impact for us is kind of core to what we do on a day-to-day basis. And if you can get all those ducks in a row, actually that gives us as an investor confidence. And the more confidence we have, the more we can articulate, identify, understand risk. Actually the cheaper capital tends to become, but more importantly, we're able to match the right kind of capital for the right kind of project.
Thank you, thanks, Rich. And we'll pick up on a couple of these points because I wonder, if where the gaps might be in some of these areas. But Sarah, I just wanted to ask you from a bank perspective, what is it that you're looking for?
Yes, so Lloyds is fairly famous for being a kind of a low risk bank. However, we are trying to expand our appetite as we look at nature-based projects and biodiversity. I think the key things that we're looking for are who's the team that's leading this? Are they credible? Many of the comments that Rich made, purpose, what is the project trying to achieve, the risks, both kind of financial and sectoral based, and debt serviceability is a critical one for us, and the kind of security of the funding repayments. In terms of businesses, that experience is really critical. We want to understand that people have experience and are able to deliver in the particular project that they've selected, and this is not a kind of isolated endeavour for them. It's worth saying that kind of any project that is under the countryside stewardship scheme is included in our CGFI eligibility criteria. So we are trying to be more expansive in terms of what we're including as eligible projects within there as well.
Great, thank you. Martin, you were, prior to Pollination, you were at the EIB's Natural Capital Finance Facility, so you've seen a lot of projects along the way. What do you think that maybe project managers are not understanding, or what is the gap that maybe is not getting them to this investable place?
Yeah, maybe to give some background on the NCFF, the Natural Capital Finance Facility. So it's a 120 million financing facility. It's a joint project between the European Commission and the EIB, and it actually tries to do exactly what was here described, to find bankable projects, demonstration opportunities for natural capital. And similar to Lloyds, the EIB is not known for being a huge risk taker. So I think that's obviously one of the challenges. There has to be the projects have to fit in the risk framework of the bank. And actually, what's really interesting is the facility now exists for a few years and had a really slow start. And I think the slow start was really because it was very difficult to kind of combine the expectations on the bank side with what was out in their market. And it goes back to many of the points that Rich and Sarah actually just mentioned. And in fact, the team brought out a really nice guide called Investing in Nature, I'm very happy to share the link. And there are actually 7 lessons in there, and they go really through to a step-by-step what is actually required to have a successful natural capital project. And I think what really was the biggest disconnect is that often the project components were not necessarily coming out of the finance community. There was a lingo kind of problem. So it's just to kind of get to know the financing basics. What is this project about? Like Sarah said, describe the project in an easy way. What's the business model? And that already was often, is still a big challenge. What is the expected impact? And then also one of some of the challenges that the team probably still facing is like, that the companies that are often implementing this, they're not used to actually dealing with a bank who would say, what's your financial standing? Can you provide us with all the information? So a lot of the information was actually not available. And the same way, the kind of a good forecast of cash flows. And then I think Rich mentioned this as well, good overview of what are the risks and what are the possible mitigants. And that can actually really lead you to analyze different financing structures and also the sources of capital. And that was the other thing. Often we were confronted actually with things that looked like we could do, but in the end we couldn't. And so I think there's a big learning to do on both sides. By the way, it's not only on the project components, but on both sides to really bring this in a form and in a language that both sides can understand it, to then see whether there's something to be done. And this guide has been really well received. As I said, I'm very happy to make it available, and it really helped the team to really improve also the number of projects that were coming, and by now they're also, I would say, relatively successful to really build a really interesting pipeline across all over Europe on natural capital projects.
That sounds like a really great resource. We'll make sure we get the link from you, and then when we send out to the IRF applicants, we'll make sure that links in there, the summaries of these, within the summaries of these panels. Dan, I know you started off with several projects, whittled them down to the few you mentioned earlier. So you've seen some of the challenges on the ground that that these projects have. What's your opinion on where the biggest gap is? We always sort of say, oh, it's the data, but actually it sounds like it's actually more governance, upskilling around sort of financial language and what finance needs. But you tell us.
Yeah, I think we shouldn't shy away from the fact that this is a new sector. We're trying to create brand new commercial models which will become investable. So that's not going to be easy. And most of the projects we're working on are effectively startup businesses, with a great idea which has environmental restoration and biodiversity gain in the heart of it. But it is nevertheless a brand new business. If you just think in the commercial sector, what it takes for an entrepreneur to set up a brand new business, how difficult it is for an entrepreneur to raise finance. We're all aware of this. It needs a lot of sort of sweat equity, then some sort of initial equity. You go quite a long way before you get to the point where you've got a business that's so stable you can go and secure a bank loan. And really, nature-based investing is no different. So I think we're in the stage at the moment where we're trying to create this sort of ecosystem where the whole sector works. And it's brilliant to hear that we've got some big funders here on this panel at the table. So there's real interest, and that should give everyone confidence that there is some capital out there chasing opportunities. And on the other side, we've probably got lots of project promoters on this conference who've got great ideas about things they want to do. Now, the missing bit is in the middle. How do you put together these projects, which are generally startups, creating revenue streams which aren't yet well established? And this is why the IRF is such a great initiative from EA and DEFRA, because that is going to give us all some capacity really to work on that and develop some of these business cases forward. And the same rules about raising finance in this sector are the same as for the social investment or any other commercial sector really. An investor or a banker is going to want to see a business plan, a financial model, a data room, and then they'll do their due diligence and decide whether to invest. So all these projects have got to go from initiation all the way through to delivering what an investor is going to want to see on that first call. Investors aren't going to want to get involved in actually trying to create the business itself. So that missing bit of creation of the business and commercialization of the proposition, that is the key to growth of this sector.
And is that a case of that projects need more resources to fund up to be able to meet that? Is it that we need a de-risking vehicle for some of these projects? Is it like the IRF, but maybe even an accelerator level? Rich, what's your sense on how we actually sort of create this pipeline like we have with renewable energy?
Suite of interventions that are needed, to be honest. The IRF is a great starting point, as I sort of mentioned earlier. 10 times that was put into the social investment sector. I think there was a willingness to test and fail, and we need to be able to do that in an environment, in the environment sector, where we've not been able to do that because there's so many stakeholders around sort of our land and our marine, and so many regulations. And you talk about the sort of sandbox type activity that happens in innovation, and we need to bring some of that into what we're trying to achieve here. And hopefully what that can help us do as well is standardize some of the activities and give us more confidence in some of those revenue streams. So I think in previous sessions, what's been highlighted around the woodland carbon code, and don't we need a woodland carbon code across a number of other carbon sinks in our nature solutions? How do we start to bring through some of that confidence factor in those? And then, as Dan was saying, the demonstrator projects, and how do we fund those demonstrator projects? Because that kind of combination of sort of the first opportunity, the early runners, and the high risk that might be there, how do we kind of compensate our investors who are looking for some sort of return for taking that early risk? And that's where things like blended finance, and we heard about that yesterday, can really play a big role. Yeah,
thank you. Maybe let's just go around the room on how we can sort of create this catalytic funding, and then we'll sort of dive back down into sort of some of the sort of troubleshooting for projects. Martin, what's your sense of what we need to do in terms of building the pipeline?
I think the experience from the NCFF, I'm going back to that show, and I forgot to mention is really that technical assistance is really key here. And most successful projects that got off the ground were actually through the technical assistance. And in the end, it was always thought the financing from the EIB is maybe attractive for the pricing, but it wasn't really, because we're in such a low interest rate environment. And as was outlined, a lot of the projects are actually so early stage that the pricing is not really the issue. But what really made the difference was if you come with financing, and you can put in front of that, you can put some technical assistance to get to the point that actually the projects are the stage where they're financeable. That's really that made the difference. And I think so. It's a great initiative that DEFRA is now planning, because that's probably exactly needed in order to get projects to the next level. That more financing sources can actually look at these projects.
Sarah, is there anything you wanted to add here?
Yeah, I mean, I think both the DEFRA project is brilliant. Mechanisms to unearth these projects is really important, making sure that we have regular mechanisms to identify projects, bring them up, make them visible, is really helpful in order to create a visible pipeline. I think also the work that Triodos is doing is really interesting. That's the type of work that's been done by the likes of the Climate Finance Accelerator, and really trying to understand what are the obstacles as was mentioned. It's not just finance. There's a whole range of other, a whole web of intricacies around how do you support these projects and make them commercially viable. So I think learning the lessons of Triodos's work, Triodos, sharing those as widely as you can would be really helpful. And all of us trying to just lean in on this. I think it's great that Triodos is doing. We should all be doing more of that. And yes, vehicles to make them more accessible would be great.
So Dan, a lot of praise for Triodos here. Do you want to anything else you wanted to add about how we can build this pipeline?
No, I think I'll just share what others have said, and Rich in particular. There's a multiple number of measures that are needed to get this sector moving. I mean, you cannot raise and repay finance unless you have revenue. So the focus has to be on how you can create revenue in this sector. And There's a list of things. I mean, revenue from eco-tourists is quite straightforward. If we go back to the Trees for Life project, creating revenue from biodiversity gain is more difficult, but there's some emerging, regulation, legislation coming through. So we need to sort of try to work out how we monetize all these various ecosystem services, adopt standard metrics, easy to measure validation, and that will then start helping projects create revenue streams which can then be lent against. So, we're on the right tracks. I think we all agree what needs to be happening here. And some of the revenue streams, we do need a bit of government support to generate these, and moving beyond just woodland carbon code, I think is a good idea. Peat carbon code, biodiversity gain, other metrics.
So a coherent strategy, really, and then maybe supported by the likes of, disclosure and regulation that comes too. I'm just conscious that we really wanted to sort of give some advice to our IRF applicants, but also we might have some investors listening, or I know we have, who might want your advice too. So focusing on those applying for the IRF, let's just talk about what not to do, perhaps. Typically, when you're presented with projects, what mistakes are you seeing being made? What are the alarm bells for you? Rich, do you want to start us off?
Yeah, so I always used to joke when I was in social investment that every phone call I got, it'd be somebody wanting a social impact bond, because it was the hot topic and everybody could see the press and they thought it was the moment to get a social impact bond, which is probably the pinnacle of kind of impact investment models. It's very complicated, quite costly, and only suits a few situations. And when you actually unpicked what they wanted an overdraft or they wanted a mortgage, something that's really simple, really straightforward. So I guess, first thing is kind of don't overcomplicate it and try and sort of match off, what kind of capital do you really need? Don't try and aim for something that's very complicated, very, very expensive, if actually you can get something that's simple. And I guess the other one, and this is probably pertinent for all investors, we often see hockey sticks. So the hockey stick growth, that kind of sort of wish for a project to show its huge potential returns. I think we're all pretty skeptical, especially in an environmental context, that investing in nature is ever going to deliver hockey stick style growth, and the number of financial models I've seen that predicted voluntary carbon prices of doubling and tripling over the last 4 years when they've been reasonably static, I think is kind of evident of that. What we want is robustness. We want confidence. I prefer people to be prudent rather than over-ambitious, and I'd prefer that they were over-ambitious on the impact rather than the finance. If we can get the finance is a tool. We get the finance right, and hopefully the impact can then follow. And if we can do things like conservation dividends and community dividends and reinvesting those surpluses back in for more impact, actually that's how you can create a really scalable and replicable opportunity.
It's interesting then, sort of not overcomplicating it. Maybe one of the mistakes people are making. Martin, no hockey stick returns for your pollination fund.
I would say that's exactly right. That's exactly what we're trying to pitch now. It is not a hockey stick fund. This is actually something where we're saying it's a long-term real asset opportunity, but not a private equity fund that will shoot out all the lights. So I think that's perfectly right. But I think I couldn't agree more with Rich on when I now go back on my previous experience at the EIB. I think following the latest fad and then of trying to squeeze projects into that's probably the thing that should be really avoided and not overcomplicating. I think I always said, actually finance is pretty simple, right? There's either equity, there's debt, or if it doesn't fit in the two, what you're actually looking for is a grant. And you can have combinations of the three of them, but in the end, that's how complicated finance is, right? You don't actually have too many other options. And I think the one thing I would say, if really the business model does not produce the revenues, and I couldn't, again, agree more with Rich on it's about the revenues, but there are huge impacts, then I think no one should be shy to actually saying, well, maybe going through an investment route is not the right route. Maybe for this, I need a grant. I need something to demonstrate this. I need these type of market conditions, and rather presenting, these hockey stick graphs and saying, look, at the moment it's not there. It's also not there in the foreseeable future. However, here are the impacts, and if we could just demonstrate that we actually can produce this impact, and then you can imagine that they were financeable. I think you get the grants nowadays. There's a lot of grant money available, and I think that's the other lesson I think we've seen a lot.
Okay, so you're being more realistic about whether you can produce the cash flows that
Yeah,
Rich mentioned earlier.
Because they have to be real, I think, and I mean, one can be creative, and I think this is an area where one wants to be creative and develop new business models. But I think there also has to be a certain realism. Okay, how far can I go with that? And I think that's so. And as I said, nobody should be shy to say, look, at the moment, and we all know nature is undervalued, not priced in. It's a huge externality. We don't have to talk about that. But if that's a reality, then maybe you should look for a way to finance a project that is taking that into account. Yeah,
and hopefully a reality that's shifting when we have the descriptor review come out and say the TNFD. Well, maybe let's talk about, we don't want to. Yeah, please.
And the key is really, but if you use that in order to demonstrate that the impact can be created, then I think this is already hugely valuable, because when you think about TNFD and all the other things, in the end, that's what we're looking for, right? If one is able to quantify those impacts, then later on with an emerging environmental market of that, then those projects can very easily be transposed into a financing structure.
Yeah. And hopefully with the task force on scaling up voluntary carbon markets as well, that might provide some pricing for carbon on this. So, not to dissuade anyone listening, or maybe you should stick to grants because that's what we're doing here. What are the revenue streams that we could be bringing in, that you are finding actually, exciting? So whether it's carbon credits, I know we've heard biodiversity net gain, commercial opportunities around tourism or forestry or agriculture. Dan, do you want to sort of share with us some of the sort of cash flows that you see are working, that are, anyway?
I think natural flood management is quite exciting, because, I mean, we're all familiar with biodiversity gain and carbon, but when you actually value those and look at the prices in the markets, the actual revenue streams are often very, very modest compared to the investment required to change a landscape. So you need a larger revenue stream. And we're seeing this in the wire catchment project. But the cost of flooding is really quite considerable to multiple parties. So the revenue stream is effectively a share of cost savings from all those parties who suffer from flooding. So the difficult bit is obviously monetizing that and convincing all those parties who benefit from it to make a contribution in the form of buying natural flood management. And that is quite exciting, because we are talking about very, very, very large figures. You look at places like Gloucester and Carlisle, regularly underwater. The cost to the insurance industry, the local council, communities, businesses, Environment Agency, reputations in shreds, when these things keep on happening. So the potential for all those parties to club together to effectively fund a reduction in flood management risk is quite considerable. And then you can layer on your carbon and your biodiversity, perhaps water quality on top of that. But that is a new revenue stream. It doesn't have a standard metric applied to it. You could apply a metric around storage of water higher up in the catchment, or it could be that some of those beneficiaries or those buyers want to see a very detailed hydrological model which shows what impact it will have on their assets. So I think this is a really quite an interesting one we're seeing in one of the pilots, which I'm quite hopeful we can really scale up.
Yeah, that really is interesting. Sarah, out of interest, obviously your bank looking at risk. How's sort of throw you in the deep end here, but in terms of flood risk, is that something you're looking at and therefore might just sort of change where you're lending and sort of act as a bit of a support to some of these projects?
It is something that we're looking at. It's predominantly something that we've looked at with regard to our insurance division. So we have the third largest insurer in the UK, Scottish Widows, and we're one of the largest home insurers. And so clearly we are exposed to flood risk, and quantifying that and trying to manage that and support customers with kind of climate resilient infrastructure and in their homes, and trying to work out what that kind of investment opportunity looks like. What we haven't yet done is kind of convert that across to, for example, agriculture, where we think about, well, how does actually this affect our lending? How do we embed risk into our lending portfolio? So that's something that I think is still underway.
Rich, anything you want to chime in on here in terms of the revenue streams?
Yeah, I'd probably say for me, I always think of it as a pyramid, and at the bottom of the pyramid, we've got a whole load of natural assets that can be used to generate revenues from enterprise models, and Dan's picked up on things like ecotourism. We spent a long time looking at parks and urban green infrastructure and how you can deliver both socially and environmentally impactful businesses from the assets that already exist in cities. It's sometimes easier to start with those proven enterprise models than some of the ecosystem services. And at the pinnacle, I think everybody recognises that the sort of health and mental health benefits that we all get from our nature, and trying to get the NHS and public health to start to pay for some of that, to pay for the maintenance and the upkeep of that would be fantastic, but that's a much longer leap. So what are the stepping stones for us to get there? And I would echo Dan's sort of stacking of these various models. Once you've got that green asset or blue asset in the marine context, what are the low-hanging fruits that you can start to pick off, and then start to build up a stack of those different revenues and deliver more value, and hopefully be able to reinvest more of that surplus as you pay off any investment that you've kind of raised to deliver those revenues.
And before we move on to Q&A, Martin, was there anything you wanted to add in here? Obviously, are you looking at sort of stacking other benefits on top of the sort of commercial aspects of forestry and agriculture?
Yeah, we are trying, of course, and the fund. Maybe to finish this point that Rich said, I think that this is exactly the experience we had also with the NCFF, that it was easier in public finance projects to actually integrate those benefits, because you didn't have to monetize them. You could actually at least estimate them, or you could do a form of a cost-benefit analysis, and that's then very easy to convince public financer to actually engage into a certain financing. And often also the numbers were so small compared to the outcomes that it was actually then very easy to actually stack on. And that's one of the, I would say, the success stories of the NCFF, to actually combine smaller lending components in a larger loan to, let's say, municipality for exactly natural capital. One example is in this guide in Athens, for example. It's exactly that. And there's not only for natural capital, there's also for resilience. So there's really greening the city and providing some green infrastructure to cool down the city as well. So it's more described in the guide, but this is I think at the moment still easier. Now, if you look in the future, obviously we would like to go a little bit further, and we would really like to see, we want to go beyond carbon in a way, and beyond biodiversity offsets where it's possible, right? So we're looking at it. It is still challenging. A lot of it is still in the voluntary market. When you look at things like in Australia, reef credits, green, those type of things. We try to be realistic and have revenue streams that are understandable to investors. But obviously, we look out for projects where we have the potential, in the hope that there is something to be done in the future. We have a long-term investment horizon. We do believe that probably some of those additional revenue streams should also be monetizable at some point in the future. Not sure whether this is for this immediate fund or for the next fund, but what we try to do is to really line up the projects and also imply a quantitative impact tool that is actually taking this into account, and that tries to value these benefits that the projects achieve. And we think that's a huge USP on what we're trying to do, and that's not there, at least not in large scale investment vehicles. And the idea is really to show investors there is this economic return that you're actually making. We may not be able to monetize it today, but there may be in the future an opportunity to do that. And that's kind of the inherent upside that investors may have. Whether this will be significant remains to be seen, but we do think it's worth to do that work now in order to show that, and then also to help the discussion on what type of revenue streams could actually be developed in addition to the few ones we have at the moment available.
Yeah, I couldn't agree more. And we forget, because we've been working on nature for so long, and so many environmental NGOs have been working so hard, say, for decades. It's frustrating that it's not here now, but it hopefully is coming. And so it's sort of a case of getting prepared now for when we do, when we can sort of find buyers, you say, for these benefits. And some of that is obviously happening now too. So moving on to Q&A, because we've got a lot of them, which is fantastic. We have some more sort of general questions for the panel, and then sort of specific questions for each of you. So I'm going to do a bit of just a mix and match, and we'll call on probably just a couple of you for each one, just for timing, but feel free to just wave at me if you wanted to chime in. So the first one from Adam Brown, South Downs National Park Authority. With carbon being one of the few current bankable revenues, we could see an over-prioritisation on this one service than a holistic view of all ES provided by Habitat. How do we avoid a funding rather than ecology-led future for habitat creation? Whew, that's a great one. Rich, do you want to have a stab at this one?
I talked about mission alignment in partnerships right at the beginning, and I think it's an opportunity that the UK actually has, because it's potentially lagging behind some of the other areas in the world where profit maximization has kind of accelerated, and what we've seen in the US is big habitat banking organizations being started by coal miners and being backed by the most red-blooded Wall Street bankers, because there are good financial returns to be made. But the ones that are actually more successful, that can deliver a better return, are the ones that are able to stack some of those benefits and able to kind of deliver higher quality habitat. So for us, making sure, and this is exactly why we're so kind of pleased with the IRF, that there are environmental NGOs and our mission-driven enterprises and our local authorities are a big part of the mix in delivering some of these sorts of investment models in the UK context, will hopefully mean that kind of public benefit is locked into those models, and it's not just a race to the bottom in terms of what's the most deliverable tariff that I can get from government for low quality habitat to be delivered.
And presumably also, if we start thinking more about like soil carbon, blue carbon, wetland carbon, it helps broaden out away from just this mad dash to put Sitka spruce in the ground for the next few years. Dan, what are your thoughts?
I think it's a good question, and I think it's down to each project to try to maximise biodiversity gain and environmental gain generally. I was aware when I was talking about natural flood management, that can sound quite commercial actually. I mean, flooding is an issue with climate change and everything, but if you're putting a project like that together, that you can still introduce increased habitats, tree planting, biodiversity gain as part of the project. And there might even be an element of cross-subsidy in that as well. And it could well be that the IRF or the impact investors in this space are insisting on seeing, the true positive environmental impact from a project, rather than just something that's purely stacks up commercially. I think the two are combined really. We want to see positive impact. We need it to be commercial, but it shouldn't be one or the other. So I think that's maybe to bear in mind.
Back in Helen as well, just to
sure.
I think organisations like Pollination, Triodos, ourselves, we've been set up with that kind of mission. It's a locus within how we deliver these things, and we need more of us in the UK context. There's not very many of us, and there's probably got most of us on this panel. And I think what we want to see is, and it's part of our duty to make sure that we do keep impact as a central part of these investment models, and it doesn't just get lost to the red-blooded private sector where profit maximisation is the be-all and end-all, and that kind of short-termism that gets built in actually starts to break down our natural ecosystems over time.
Yeah. Martin, did you have anything you wanted to say? Maybe just saying, I think there are a few examples where actually the combination of return and higher impact also led to a higher value of the project. So I mean, we've seen this maybe not in Europe yet, but we have a few examples that a few of our colleagues worked on, where when you exit a project, that actually there are investors out there that already look, maybe not the most commercial investors, maybe more also impact focused one, but they really want to see the impact. And there's also willingness to pay at least to some extent for that. And I could see that with more pressure on also on companies, on finance institutions to look into this, that there could be a shortage of this type of project that actually then really allows that this is then really also transferred into a real kind of financial benefit, because I think all the early movers now have a chance, if they set this up rightly, to actually be there in a few years. And then maybe investors may look at this slightly different, perhaps because of TNFD, perhaps because of they have a net zero target, perhaps of because there are actually some environmental attributes that are monetizable, which changes things. So I think that could actually really change the picture slide. Yeah. Thank you. so more specific questions here around sort of habitats and things like that. So let me see this one. It's from Henry Head or Heed, apologies if I pronounced this wrong, from the Soil Moisture Retention Limited, SOMELCO. Unsurprisingly, a question about soil and retention. There's a lot of concentration on carbon sequestration. It's acknowledged that there's an imminent water shortage crisis. Shouldn't water sequestration also be a hot topic? So I wondered, maybe have any of you seen or are you looking at any projects, or have you seen any sort of interest or ability to commercialize water sequestration? And if none of us have, I think that's the answer to the question, I'm afraid, Henry. No, not yet.
I think, look, can I just sort of segue with that, Helen? Because I think the water companies, you know, are an equally important part of this sector. And you know, there is an increasing recognition that nature-based solutions play a part in their delivery options. And Ofwat has a big innovation fund that it's just launched, in which it's specifically targeting nature-based solutions as part of that. So there are a number of funding streams that are coming online, and a number of significant actors in this space that are starting to kind of wake up and see nature as an important part of this, and investment in nature as a way to actually stop putting grey infrastructure in the ground. So while we might not yet all have case studies of water sequestration projects with nature-based solutions, hopefully in another couple of years' time we will. Because 3 years ago, you know, this conference didn't have as many live examples of real nature-based solution investment projects on the ground as it does today. And we've moved a long way in 3 years. Yeah.
Yeah, and in fact, you know, I know Eric Letzing, I didn't get to talk too much about it yesterday, but the Iowa Soil and Water Fund, I mean, one of the whole points of marrying that together was the soil sequestration, the water sequestration of the improved soil health for that fund. So maybe that's something to take a look at, Henry, the Quantified Ventures Iowa Soil and Water Fund. This question's moving around, but there's one here on pollution tax. What does the panel think about a pollution tax for the creation, sort of supporting, I'm sorry, I'm butchering this question. It's from Jane Lippington and Moorgate Seas. I'm sorry I'm butchering your question. Does the panel support a pollution tax for the creation of a revenue stream for large-scale restoration so that polluter pays? In your experience, is that going to make a difference would that make a difference in sort of giving you more confidence, acting as a signal, increasing potential buyers of these services, or reducing impact on nature? Sarah, do you have any thoughts?
Yeah, I think in principle, not against the polluter pays principle at all. I mean, it's the reason that we support a robust carbon tax. I think it makes perfect sense. You know, how you would use that revenue stream, I'm not sure whether you would carve that off and use it for something specific. But I think as a principle, it makes sense, and it's worth, as we head into COP26 and the government is looking across the board at, you know, how they implement different taxes and spend decisions. We want really climate to be integrated into all of them. So it'd be good to look at both kind of carbon tax, polluter pays principles, and others as well, just to make sure that we're trying to be as ambitious as possible across the piece in this really important year that's coming.
Thank you. Just moving swiftly through these, Martin Faulkner of Nature Scott says he hasn't heard anyone talk about urban green infrastructure. It's true, we haven't talked about urban green infrastructure, and yeah, you know, I know, Rich, that's what you look at. Martin, the NCFF looked at some of that. Is that an easier lift for investment, urban green infrastructure? Martin?
I would say a lot of urban infrastructure financing is public, and I think that's what the point I tried to make. I think that's where the NCFF has been the most successful, to actually integrate some natural capital solutions into larger urban infrastructure financing. So that also really showed that some green infrastructure can be more efficient than grey infrastructure. And yeah, there are a few examples there. The Athens project is one. There's a Polish project as well where that has been done, or where components like larger social housing projects and to include green roofs, things like that. So there is an opportunity. I'm not too sure whether this is though allowing like we're also talking about how we engage the private sector. That's obviously sometimes a little bit more challenging to kind of to make the link. And the reason for that is that a lot of the revenue streams are very commingled there. And that it's just easier if you have a larger anyway in an upgrade program within an urban area. Then it's so much easier to integrate a natural capital solutions than just to try it on a standalone basis.
Rich, do you want to add anything about urban green infrastructure, some of the challenges that you've seen?
I think context for the UK is pretty horrendous. So 4, 5, 6 years ago, we were talking £2 billion a year just spent on maintenance, and now it's in a couple of £100 million for local authorities. Everything's starting to see big capex backlogs, and spending on new urban green infrastructure is really light. But I'd kind of echo what Martin said in that a lot of it comes back to public spending. So one of our partners, National Trust, earlier this year was campaigning for a large spend coming from the government's overall infrastructure spend to be on access to nature, urban green infrastructure, peri-urban forests. And as part of that, the investment that was required from the private sector wasn't actually in the creation of the urban green infrastructure, but creating revenue models using those assets in order to pay for the long-term maintenance of those models, so that it wasn't just a liability on the public purse. It actually became an economic benefit, a real economic benefit to the local authorities in terms of job creation, in terms of new enterprises being created, things like forest innovation zones or forest enterprise zones. And trying to catalyse an economy around our urban green infrastructure has been, something that we've been trying to do for sort of 2, 3, 4 years. But it is a tough area to work in. Exactly as Martin said, no direct line of sight to a simple revenue. Lots of commingled beneficiaries, lots of different areas of interest, and lots of vested interests actually as well. That makes that governance question that we kind of talked about earlier a really tricky one.
Mm-hmm. Thanks, Rich. Thank you. There's lots of questions sort of specific. People just want to know what you would look at. And one of them is salt marsh restoration. Is this sort of too out there? Is it just people are comfortable with woodlands and not going as far as salt marsh at the minute? Dan, obviously you've worked on some of these projects. Do you want to share what your thoughts are on this?
No, I think salt marsh restoration is fantastic for carbon sequestration and biodiversity. Potentially can lever in ecotourism revenues, and this is why we're working on the project in Devon. And Harry Barber is speaking tomorrow actually on that project. So I think one thing to remember: the 4 of us on this panel, we are really from the finance sector. So obviously we're going to have questions about the viability of your business model. We might give you some help in trying to commercialize it, and ultimately maybe help with the investment. But the actual design and promotion of the proposition has to come from someone else. So a lot of these questions around new sort of projects and types of ecosystem services, really we're reliant on NGOs, environmental NGOs, other promoters to actually put these projects together and bring them to the funders. So we will have a view on them. And where I sit is if anyone brings a project to Triodos which can generate, which demonstrates environmental restoration, biodiversity gain, we'll look at it. It doesn't matter where it is or what the outcomes are. But the first point will be, is this a commercial project? Is it suitable for raising investment, or do you just need a grant? So I think we'll have a view on all these things. But there's a whole range of other people probably in this audience who are the ones who need to put these projects together and bring them to us, actually.
Yeah, actually, I just want to ask this quick question because I think it's really important, especially for IRF applicants. What should projects be looking for when they're approaching an advisor or an investor? I appreciate not everyone here on the panel is an advisor. I think it would be helpful if people heard, because I'm sure lots of, as you mentioned, as this becomes a bit more in vogue, lots of people are going to be hanging up a shingle. So Dan, while we've got you, what should projects be looking for in an advisor?
Well, I'm an advisor, so I'm an intermediary. So in a way, a project might come to me and say, we've got a great project, we need to raise some money. Can you help us do that? And I'll have a view on what it takes to become investable, because that's what I've done in my life. So I'll have certain questions about that project. How robust are those revenue streams? What customers, what evidence have you got those revenue streams are there? What's your, I'd really evaluate the business plan and evaluate whether it is investment ready or even capable of becoming investment ready. If it's not, the advice would be, this is not an investable proposition. You need to go and get a grant. There's nothing wrong with that, but let's just be upfront about that. If it is potentially investment ready, then the thing would be to say, look, the IRF just launched. There's potential to get some support to turn this into something that is then going to be in a position to be able to go to Martin, Richard, or Sarah to actually raise the finance. So this is the whole purpose of investment readiness, is to fill that intermediate step between a great project idea with, you know, some good initiatives to something which an investor will actually look at and spend time on.
So yeah, Rich, please do share.
Turning the question around as well, I think it's you know, really important for people to think about the right partners for them. You know, as Dan said, Dan's been doing this all his life, but when we were in social investment, we saw that £100 million of investment readiness turn up. We went from, you know, a handful of advisors to over 100, and it's really hard to assess quality. So what I'd say is that anybody looking for help and advice, you know, you might have to kiss a few frogs, but make sure that, you know, when you're going to an advisor or to an investor, it's a long-term partnership that you're looking to build. It's not a short-term transactional relationship. And you want to make sure that you've got somebody who is aligned to you, that can deliver the quality that you're looking for, and who you're happy to pick up the phone to at 9 o'clock at night when everything is hitting the fan and it's all going wrong, and you can, you know, work it out with, because, you know, that's the reality of the hard yards that need to happen over the next couple of years.
Thank you. Thanks, Rich. Martin, anything you wanted to add?
No, I think, well, maybe I encourage again to look into the guide that we prepared, because I think it really kind of goes through this in a very systematic way.
Right.
So if you don't want to pay for an advisor in the first instance, before you actually go into that, have a look at that.
I feel we're all frantically Googling for this guide right now. So, but I'm sure everyone who attends today, you will get the link if you cannot find it.
If you Google EIB NCFF, it comes up immediately.
The guide comes
I'll send you the link, and then we'll share it.
Thanks, Martin. Fantastic. So we're a little over, and I just really wanted to ask a quick fire round, and then we'll wrap up in 3-4 minutes or so. There's a question here about, you know, this R&D and technical assistance. Does anyone have any ideas on how we can develop that pool of funding more? I think we're all looking for that. More technical assistance. Is it sort of being smarter about the grant money? Should foundations be saying things like, you know, we'll, rather than just give you this money, we want it for R&D, or we want it to be a sort of an investment guarantee, or have you crowd in more finance? Does anyone want to share on this? And I encourage you, just because we're running out of time, just to wave your hand at me if you have an answer. Rich.
So, you know, we've tracked the sort of the US environmental investment market, and you know, when we started Finance Earth, it was worth about $5 billion, and it's now $25 billion and 220,000 jobs. The restorative economy in America is bigger than coal and steel combined. And why? You know, actually, their venture philanthropy market, how they use your grants, exactly as you said, Helen, is much more focused on how do I build enterprise, how do I build sustainable models, not simply how do I commission an impact in a single transaction. So I think being more creative, being more adventurous at that kind of early sort of foothills, and then that grant funding coming in, whether it's philanthropic capital, whether it's public capital, but having an eye to building longer term sustainable revenue generating models that could be investable is a key starting point for us.
Thanks, Rich. So I think we'll just do one question round and then we'll wrap up. So real quick fire question, and just a few words in your answers, if you can keep them to that. What really excites you most when you're looking at the nature-based green finance landscape now? Dan, do you want to lead us?
Yeah, I think for me, it is potential for learning and scale. And I think the IRF should be supporting projects at scale. What I hope is it supports a small number of high quality projects with dedicated resource, so we can make a meaningful impact, and it doesn't support dozens and dozens of small projects which aren't investable.
Thank you, Dan. Sarah, what about you?
Yes, I think what excites me is that this is the answer. Scaling up these solutions is absolutely critical. We need it to happen. We need it to happen fast, and so that's what keeps it exciting. And there is potential for scale, and but lots of problems to solve in the meantime.
Martin?
What excites me really is that large-scale investors have interest in nature-related investments. They don't know exactly what it is, what they want at the moment or they can do, but there's a real interest, and I think COVID has probably helped in that, but it's a real change. I'm watching this for many years, and I've never had the largest asset managers of the world coming to us and saying, look, we really want to do something. That excites me, but I think I can only highlight that requires that you get to the scale and that you actually get business models done. So I can only echo if the IRF could really focus on scalable investment products. I do think there is a real opportunity now to move new money into these areas.
And once we start to have these scalable projects, then it helps the whole pipeline come up.
Yeah, I mean, that would have been my answer actually to the previous question, right? So I think that's one way you can have more. You probably said a combination of both. You need more technical assistance, but if you actually get really this part of the equation right, then I think you can really see the market taking off. And
Rich, ending with you, what are you excited about?
So for me, I think it's the ultimate owners of all of the capital in this world are kind of running ahead of us, the custodians. There's a demand building from the general public to invest and restore nature, and we need to catch up, and we need to create the projects that can allow that capital flow to happen. And if we can do that, those taps won't be turned off. If we can deliver a fair financial return and impact, they'll be opened up. And that's just going to be transformational for restoring nature and kind of rebalancing people, planet and profit.
Brilliant, thank you. And thank you all panelists for not only joining us today, but your commitment to building this pipeline and building this sector and being the pioneers. So thank you so much. And thanks to all our audience for your participation. I know there were so many questions we didn't get to. Hopefully we'll get to those in breakout sessions. If you haven't signed up for one of the 2 sessions, you can do that, or you can email me, helen.avery@gfi.green, or my colleague Brendan Curran at brendan.curran@gfi.green to sign up for those on the 2nd or the 9th. You can also email IRF at environment-agency.gov.uk for more information on the IRF, and I'm sure they'll point you to the breakout sessions as well. Just a reminder tomorrow that we have presentations from projects that are on their way to investment readiness, who will share some of their challenges and tips. Today's was recorded, as was yesterday's. Tomorrow's will be too, and you'll find the recordings on GFI's website probably next week, maybe even at the end of the week. We'll see how that goes. So you will be able to look at them in slow time as well as real time. So that's it from us. Thank you so much again. It's been a real pleasure. Enjoy your evening or afternoon wherever you are, and the rest of the conference. Thank you all.
Well, thank you very much, Helen. That was Helen Avery of the Green Finance Institute. What a fantastic day of discussion we've had. Over 500 people have been involved as delegates. We've heard from 21 experts drawn from finance and all levels of government. The good news is that as delegates, you have another great day ahead of you. Join us at 9 a.m. GMT. We'll be in conversation with 2 leaders from the water industry about nature-based finance. Then further on at 11 a.m., we're assembling a highly qualified panel to talk about the future for markets, for environmental services and net gain. Then there's the closing session with addresses from ministers from government in Westminster and Edinburgh. Tomorrow, look out for an exciting new report that will be launched here at the Natural Capital Finance and Investment Conference. It will address how to put nature onto a sustainable financial path in 2021. I'll leave you in anticipation for that. But of course, the closing session is not the end. As Helen Avery just mentioned, you can join her for a further Investment Readiness Fund webinar at 2:30 p.m. Tomorrow, spread the word on social media, #NaturalCapitalFinance2020. As we close today, I would once again like to acknowledge the support of our fantastic array of sponsors, particularly headline sponsors, Finance Earth and WWF UK. So from us, the conference team at Ecosystems Knowledge Network, it's goodbye and see you tomorrow. Thank you.